Welcome, fellow investors. Today we are diving into the world of ETFs, helping Europeans navigate the best options for their investments. From keeping it simple to maximizing your returns. We've got you covered. So stay tuned for practical tips on choosing the best ETFs for your portfolio. So let's get started because investing in ETFs can be confusing for Europeans due to regulations. If you want to buy US ETFs, you are not able to, right? Yes, you are. And I will tell you in a minute how you can buy these ETFs yourself. Because many European investors face obstacles when they try to purchase US ETFs directly. Because you are not allowed to, right? So a lot of channels are recommending to buy European ETFs because you have no other option, right? But I have good news for you because I will explain how you can still invest in specific US ETFs hassle-free with a simple but effective legal workaround. And you are still able to buy popular US ETFs with low costs and global diversification. I will share a link with the video in the description below with my step-by-step workaround. So you can benefit as an European investor from the US ETFs as well. Plus, I provide you with a 7-step checklist designed to help you select the best ETFs for your investment goal, aiming for returns of 8 to 10%. So whether you are looking to invest $100 or $100 per month, or you have a larger sum to invest, this video has you covered. So let's dive into the strategies for choosing the best ETFs to potentially earn 8 to 10% returns on your investment. So let's start with step number 1. What's the reason why you want to pick and buy an ETF? So the most important one is don't just choose only the S&P 500, but consider more widely diversified ETFs. So why would you buy an ETF? Buying an ETF, an exchange traded fund, can be a strategic investment decision for these 6 reasons. Reason number 1, diversification. ETFs typically hold a basket of securities such as stocks, bonds, or commodities, which allows investors to achieve instant diversification with a single click of a button. It makes investing really simple for individual investors. By spreading investments across multiple assets, ETFs can help reduce risk compared to investing in individual securities. Then step number 2, low cost. ETFs often have lower expense ratios compared to actively managed mutual funds. This means investors can access a diversified portfolio at a lower cost, which can help improve overall investment returns over the long term. Then number 3, liquidity. ETFs trade on stock exchanges, which means they can be bought and sold throughout the trading day at market prices. This provides investors with a liquidity and flexibility, allowing them to enter and exit positions quickly without waiting for the end of the trading day. Then we dive into step number 4, tax efficiency. ETFs are structured in a way that can make them more tax efficient compared to other investment vehicles such as mutual funds. Then number 5, easy access to different markets at the same time. ETFs offer investors access to a wide range of markets and asset classes at the same time. In general, whether you are a beginner or an experienced investor, ETFs offer a simple way to enter the global economy and potentially achieve an average return on your investment ranging from 8 to 10%. So let's look at step number 2. What ETF should you buy and why should you buy it? So I've been in the financial industry since 2008 and I've seen many portfolios managed by asset managers. And believe me, keeping it simple, keeping costs low and choosing the right ETFs shouldn't be that difficult. ETFs are like magic bags that hold various investments inside. They offer exposure to everything from companies and industries to locations worldwide. And do you know what the best part is? You only need one or a couple of these magic bags to diversify your investments and capitalize on major economic trends with a good return on your investment. However, some fancy pants asset manager collect tons of these magic bags, and it seems like they are doing a lot of good work, making it look like it's complex and complicated. But guess what? The truly successful ones stick with just a couple of these bags. So why make things more complicated than necessary? Stick to a couple of magic ETFs and you will have the entire economy at your fingertips. That's why I personally invest in 2 single ETFs. But remember, this is not a financial advice in any way. But to give you the most out of this video, I will share the ETFs that I prefer to buy for my own portfolio down in the comments below. And these ETFs are the same that big asset managers purchase for their clients. So it's really simple. In another video, I will cover more details and we dive deeper into the ETFs like performances, costs, and other important information. And if you want to follow these videos, please subscribe to our channel and you will receive valuable information for maximizing returns on your investments for free. So buying ETFs like these is like hitting 3 birds with 1 stone. You get broad diversification, keeping your eggs in multiple baskets, low cost so you're not losing money to fees, and good returns because you are investing in the overall growth of the economy. It's simple, it's smart, and it is way effective. So then we dive into step number 3. Choose physical versus synthetic ETFs. Imagine you want to borrow a book from a library, but they don't have the specific book you want. Instead, they offer you a copy of the book's content. It's similar to the real thing, but it's not exactly the same quality or experience as reading the original book, right? That's kind of how synthetic ETFs work. They mimic the performances of certain assets, but they are not the real assets themselves. So maybe this sounds a little complicated, so I would stick to the physical ETFs. Physical ETFs are like owning toys directly from the store, and you can see exactly which toys you have, like a Lego set or a Barbie doll. Physical ETFs directly purchase and hold the underlying assets they track, such as stocks or bonds. This means that when you invest in a physical ETF, you are essentially buying a small piece of those actual assets. And it's like owning a piece of the pie rather than just buying a picture of it. Physical ETFs buy the stocks physical. Then we dive into step number 4. Choose distributing versus accumulating ETFs. In simple terms, that means distributing ETFs give you regular payouts, while accumulating ETFs reinvest your dividend earnings back into the ETF to help your investment grow over time. So it's a small difference depending on your personal situation. So the next one is step number 5, but one of the most important ones. If you get this one right, you will have great returns on your investment, and I see a lot of investors are losing money here to asset managers. And that is step number 5. Go cheap and track the costs. Look for the lowest expense ratios. And I have a specific video about why costs matter when you want to invest. These ETFs, what I will share with you in a moment, are low-cost ETFs with a total expense ratio of 0.03% to 0.08%. So when you are going to invest in stocks or bonds and you let your money do the heavy lifting for you, there is a direct correlation between cost and the return on your investments. So be wise, and when you go for low-cost ETFs, you will get high returns if you select the right ones. It is as simple as that. Then we dive into step number 6. Go big and broad. Select ETFs with substantial size to stay away from bid-ask spreads issues and potential fund closures. Choose an ETF that offers broad diversification, providing exposure to the entire economy. Consider the number of stocks in which they are invested. Look for ETFs with a respectable track record and track the total net assets of the fund. Total net assets reflect the cumulative investment of all shareholders in the fund. So the bigger the total net assets, the lower the risk. So the larger the total net assets, the more money the fund has to work with. And then the last step, step number 7. Choose the right ETF listing, consider currency and liquidity. I'm buying ETFs in US dollars, so that can be a certain risk as a European investor who pays with the euro. Liquidity refers to how easily an asset can be bought or sold in a market without significantly affecting its price. So imagine you have two cars that you want to sell. The first car is a popular model with high demand in the market. Whenever you decide to sell it, you receive multiple offers from interested buyers and you can easily find someone willing to pay a fair price. Now consider the second car, which is an outdated model. Whenever you try to sell it, you struggle to find interested parties, and even when you do, they offer much lower prices than what you expected. This car represents an asset with low liquidity, comparable to an ETF with limited trading activity and low demand in the market. In the context of ETFs, liquidity is crucial because it affects the ease with which investors can enter or exit their positions in a certain ETF. So now I saved the best for last. What are the top ETFs that I personally purchase? Well, as an European investor, I opt for Vanguard ETFs from the US. My favorite includes the Vanguard Total Stock Market ETF and the Vanguard Total International Stock ETF. These are solid choices for building a diversified portfolio. So if you found this video helpful and you want to go more into detail about these ETFs, let me know and feel free to ask any questions in the comments below. Also, if you're interested in learning more about how European investors can buy US ETFs, check out the video link in the description below with the workaround. I hope to see you in the next video.